So welcome everyone. I'm Hannah from the Bangor Public Library. Just wanted to say thank you all for joining us today for this first in our new round post-summer of these workshops that we do in collaboration with SCORE. We do a different topic just about every month for small business owners and entrepreneurs. And today we are thrilled to have Karin Petrin here to talk about financials. I'm going to hand it over to Donna from SCORE to tell us a little bit more about SCORE's work and introduce Karin.
Great. Thanks, Hannah, and thank you to the Bangor Public Library who co-sponsors this series with us. SCORE is a volunteer organization. We have about 130 volunteers, mentors in the state, and we offer free advice on business. So you can be pre-startup, you've got an idea in your head, you can be starting up, or you can be an established business. We'll work with you really for the life of your business. The 130 people, we've got people who are good at social media, people who are good at manufacturing, finance, you name it. So if you come to SCORE, it's likely that you'll meet with more than one person. And if you're interested in having a SCORE mentor, just go to score.org and ask for a mentor, and we'll match you up with someone who could best suit needs. I'm very excited today to introduce Karin Petrin. Karin is an entrepreneur herself. She's worked with New Ventures Maine. She's a recent SCORE volunteer. So Karin really checks off all the boxes. And she's also able to do something that is really important, which is to explain business financials to people who say, I was never good at math. I can't believe that I have to look at numbers in order to start my business. So since we've heard that so much, we asked Karin to come on today and really just start us with fundamentals of some of the business financials, some of the terms that you'll hear. And with that, Karin, take it away. And thank you so much.
Thank you. So hi, everybody. I do want to just give you a little bit of insight. I have a large screen behind my laptop. So if I'm looking above you, it's really because I'm looking at you guys who are situated right above my camera. I also run a fairly informal kind of setup because numbers are hard. Business financials are boring. They're kind of dry. So, I'm hoping that you'll be interactive. So thank you for being here and welcome to Intro to Business Financials. As I said, we have a lot of technical jargon. So please make sure you check in either in the chat or raise your hand and let me know if you've got any questions. I believe Hannah's going to be managing the chat, so she'll let us know if you've got something pressing that you'd like to know, and especially if you need more explanation. Okay, so there's a lot of, like I said, technical jargon, so please check in if you need some extra help. So what I'd like to start with is just have you guys put your name, your location, and your business in the chat. That helps me to kind of customize what I'm talking about to your specific businesses. If you need help after this, please feel free to reach out. Really, this is not a one and done. A lot of times you need some space to sit with the content and understand it, process it a little bit, and then you can go ahead and reach out and say, hey, listen, what did you really mean about this stuff? What is this about? So what I'm going to do right now is I'm going to put a file in the chat while you're doing that. And this file, we're going to look at this together afterwards. Maybe I'm not.
I'll send out a follow-up email. So if we can't get it into the chat, if you send it to me, Karin, I can make sure everybody gets it.
Yeah, it's not giving me local access. Chat's not giving me local access to my file. So that's right. I have them plugged into the slides, but they tend to be little. So great. Thank you, everybody who's populating the chat. Oh, Gilbert Christian, that's my maiden name. Might be related. Lots of good different types of businesses. I love this. Okay. Great. Thank you for sharing. That's wonderful. So I'm going to start.
I am working in my sawmill office. You may hear background noise, or I may have a customer pop in. So I may disappear here and there.
Certainly. Thanks for letting me know. So I'm going to start with some fundamentals, right? We're going to start like kind of at the beginning. For some of you, this may be a reminder. You're like, I know what bookkeeping is. So what is it? Bookkeeping is when you take all those financial transactions, all those receipts, okay, and you format them, you organize them, and you put them in an order by categories that make sense to tell the story of your business using numbers, basically. It helps you to make decisions. When you have that information organized in a format you can refer to, it makes sense in helping you to make those decisions. It's also part of the accounting process. So it's like the first step in the accounting process is organizing all this data, organizing all this information, and then you can put it into a format like financials, which we're going to talk about. Those financials help you, your lender, and your buyer. They also help you with tax preparation, right? The dreaded tax. It's helpful for you to report out for grants and loans. Like recently, there was some loan forgiveness that really there was a lot of issues because folks didn't have good record keeping. It also helps you to evaluate the health of your business and plan for future growth. So like you can't really know where you're going if you don't know where you've been. I'm sure you folks have heard that before. And so bookkeeping helps organize, create the financials. The financials are able to tell you that what that is, where you've been, where you're going. You know, can I afford to hire an employee? Can I afford to buy another piece of equipment? Can I afford to build an addition or invest in potential growth, right? So it also helps you to take a pulse of where you're at. Am I doing well? Am I not doing well? What might I want to do different? So some of you have some products, and I would think you have more than one product. So I'm looking specifically, Penelope, you're a good example of that, right? You probably have more than one product that you're running. And so which one's making money? Which one's actually has profit? Which one maybe doesn't have as much profit? How do you want to focus? So these documents will help you to be able to make that decision and focus your effort on where you're making the most money and where it makes the most sense for you. So I kind of mentioned that why we do this bookkeeping is to organize things into these statements. And so we only have a little time. So I'm going to cover the first three of these, which are the basic statements. It's the balance sheet, the income statement, and the cash flow projections. And I wanted to clarify that the other statements that your accountant or your financial professional may use is a statement of cash flows. So there's a difference between those two. A cash flow projection looks forward to the future. It says, this is where my money's coming in and coming out. And we're going to talk about that. And what am I going to do with that money? Where's it happening looking ahead? A statement of cash flows tells you how you used your cash historically. So it's backwards looking. So it's really important to understand these two financial statements, although they sound similar, they're very different in what they do. What I will do, we will touch in and we will dig into the first three. The other two you can check in with an accountant or tax professional on so that to get a better explanation if you feel like you need one. But before we dig in, those financial statements, right? So there's two ways that you can do, there's lots of ways you can do bookkeeping. One of which is the box job, which are definitely not recommended. That's when you take all your receipts and you put it in a box and you pay for your accountant or your tax preparers college for their children, okay? Because you're going to pay through the nose if you do that. So not recommended. Automated systems are an alternative to pen and paper because they're going to take all that information, you're going to type it in there, and it organizes it for you into the financial statements. So you tell it what category it goes to, and then you just hit print, and it prints out. You can print your financials, those three that we're going to be talking about. There are different systems that you can use, and those systems, although not created equal, each one has its own unique bits and benefits to you independently or individually. And the costs are all different as well. So you can get free trials. You can get, with some of these, you can get them for free. Some of them are free, but you have to pay for the financials. Some of them are buy one time and non-subscription. Some of them are subscriptions. So what makes sense to you is individual to your business, and you'll need to pick the one, do the research and find the one that works for you and your business. So let's dig in. Profit and loss statement is one of the three that we're going to talk about. And this statement is also known as the income statement. So you may have heard it referred to in both contexts. There's a little sample statement there, and part of that file that I would like to upload for you has larger versions of these in it, so you can look at them. This statement tells you one really important thing right out of the gate. So when you look at the numbers, it tells you, am I making money? Okay, so we haven't, no math. Am I making money? Okay, this is very similar to the IRS tax form, the Schedule C, which if you're a solopreneur or a sole proprietor or a single member LLC, you'll use a Schedule C to prepare your taxes. And so you'll see these categories here are all aligned very similarly with the Schedule C because it helps for tax time, right? Really easy to just copy from one document to another. One thing that's important is that your profit or your net income is not your cash available, okay? This is not necessarily what is in the bank. For some of you, if you have low expenses and it may be, maybe they're timed so that it may be what's in the bank, but most of the time it is not. So be mindful that net income does not tell you what you've got for cash. It tells you how much money you have made, how much money you have spent, and potentially what you're going to have to pay taxes on. The next one is the balance sheet. So a balance sheet is, again, categorized. It's got all these categories. They're grouped together by specific types. So you have your assets, which are the things that you have. You have your liabilities, which are the things that you owe. And then your equity is what is left. That's what's yours at the end of the day. So I like to use an example like a vehicle, like a car. Many people have a car loan or a mortgage. Many people own a home and have a mortgage. So whichever applies to you may be relatable. So when you buy a car, you may take out a loan. And so let's say you buy a car, it's a $5,000 car, and you take out a loan for $4,000. Okay, so you have a car worth $5,000. You owe $4,000, and what's yours is $1,000. So that's your equity in that vehicle. Same can be said for a mortgage on a house. If your house has value minus what you owe, what's left is yours. It's kind of the easy example of it. A balance sheet will it's a snapshot in time. So it's one time. So as of typically the end of the month, the quarter, the year, most folks do it at the end of the year. Like, what do I have that's mine at the end of the year? And it's a moment in time. Up to that point, all this stuff accumulates. And when you look at it, you say, okay, here I am. This is today. Tomorrow, it may change because you might pay a bill and your cash goes down. But so doesn't your liability because you don't owe that money anymore. It's also important for valuation, which we'll talk about later. The third really important financial statement is the cash flow projection, okay? This one document, it's an Excel spreadsheet. You just plug in your numbers. It does the math for you. And it typically covers a 12 to 36 month period. This document here tells you if your business is viable. Okay. Will my business support itself? Will you be able to get paid and make your loan payments? So, because only cash pays your bills, it's really important to review this frequently to see if you need to make any adjustments in your estimates. So again, it's a matter of plugging in. These are my sales. These are my expenses. These are my payments. And then it should total itself at the bottom and roll over to what's available. So think of it like a running register or a budget, but it's looking forward. Where's my money coming in? And it's all about timing too. Because when you make a sale, you may not get paid for it right away. You may have terms. And so if you don't get paid for it and you're still paying all of your bills during that first month, your cash in may not come to the next month. So what do you do? How do you fill that gap in the meantime? Okay, so this is the document that you would use to figure that stuff out. Really, I like this format, but I also like to have a little column in there that is an estimate, that is an actual, because you're estimating with all of this. And if you have an actual column, then you can match them up. How'd you do? Okay. How did you do? Does it line up? Were your estimates on par, right? Or not? So you want to be able to track that. And I find adding an actual column really helps with that analysis. Okay. There's some content. How you doing? Let's check in for a second. Anybody have any? Go, Dwayne, I see you. Question? No? Okay. Your box is yellow. That's why I asked. Go ahead, Chauncey. Did I say that right?
Yeah, that's right. Can you hear me okay?
Perfect. Yes.
Okay, so I think going over kind of what you've talked about already, the one thing that's confused me is the difference between owner's equity versus owner investment, right? So, and maybe it's just the terms are similar and I'm getting them confused in my brain, but I guess when you start the business and you pull from whatever other resources and invest initially in a business, right? For me, so we have a short-term rental, so we have to buy furniture and artwork and all this stuff, right? So we pull that out of the funds that we have from our personal funds. That's owner's investment, right? But then I guess it also could be considered owner's equity if that furniture has equity value. I don't know. I guess can you help me just make sure I'm clearing that up in my brain the right way?
Yeah, perfect. Good question too, by the way. So if you think of it this way, owner's investment is half of the equation that is owner's equity. Okay. So you're investing money, and at some point, and I'm going to ask, are you a sole proprietor or an LLC?
So this one is it's actually a partnership LLC between my wife and I. We decided to do a partnership LLC.
Okay. And you're listed as a partnership LLC. Okay. Yep. Gotcha. All right. So your investment is half of the equation. The other side of that is going to be called members draw, and it's also an equity. So you're going to be drawing money out. The net effect of that is owner's equity, because what you take out is going to offset what you put in. And so owner's equity becomes the subtotal of that line. Okay, good question. Anybody else? Oop.
There's some questions in the chat. Will there be document templates provided? A couple people want to know are those the documents that you're going to send out, the examples?
So I have, back here, you can see this document, this sample here where you see the balance sheet, XYZ balance sheet. That's a sample. And so isn't this income statement? Those are in a file that will be sent out. As far as like blank templates that you'd want to use, I believe we have lots of those in our resources on the SCORE website.
Yeah, I would add to that, Karen, is so for those of you who are looking for a document that you can just fill in yourself, there are, as Karen said, plenty of those on our website, and you can either email Hannah with kind of your request for those, and then what we can do is sort those out and give you the links for those, because they're all the documents that Karen talks about. We've got blanks And they're definitely fill in yourself, and most of them are really pretty easy to fill out.
Okay. Thank you, Donna. I see your note, Steve. I'm not sure that's relevant though yet. Let me think on that one. That might be a little too deep dive for some of them. Okay. Thank you though. All right. So, great. Any other questions before we move on? Okay. If you do have some, pop them in the chat. We'll definitely get to them. So let's talk about the other side of why we do this. So there are, call them areas that a business might run into trouble, okay? When it comes to cash and how you handle cash, one of the reasons that you want to have your financial statements accurate is that they're going to tell you different things about where your business is at. Remember I said earlier we're going to take the pulse of your business. So when you look at your reports, if you see numbers high in certain areas or low in certain areas, they're going to tell you certain things. So one set is that you have too much stuff. I see oftentimes businesses with inventory have too much inventory. And so what happens is all your cash is tied up, all your operating cash is tied up in inventory. It's tied up in stuff. And so you have to get rid of the stuff in order to get the cash. Well, if you have bills that are due, they don't take stuff to pay the bills. Okay, they only take cash. So you want to make sure you go get cash. So when you're looking at those financials, and we'll look at them again to show you that if you have too many assets, if your debts are too high, like you owe too much money, maybe you've used debt to fund your inventory, maybe you've used debt to fund your assets, and you've got too much debt, and so that's a cause for concern. You also have space where maybe cash timing becomes an issue. So you're looking at it and you're going, geez, I have all these accounts receivable. All these people owe me money, but I don't have the cash yet. And I need to pay my bills today, but I'm not going to get paid for another 30 days. Or maybe it's 15, or maybe sometimes I've seen businesses run 45 to 60. If you're in healthcare, which I think, Andrea, you're in health and wellness, Maine Care, I think, is pushing 6 months. Okay, so where is that timing? Okay, where's that cash? Because you got to pay your bills today, but if you're not going to collect on that for 6 months, you better have a bridge to get you there. And this helps you to identify that. Payables is the same thing, right? You owe the bills now. Where's your cash? If your payables are too high, what is your timing on paying out those funds? Okay. Can you hold those bills to full 30 days? Not the greatest idea, but can you hold them until your cash comes in 15, 20 days? So if you're providing terms, that can really tie up cash as well. The other side of this is the profit effect. So, I've heard often, and I've made this mistake in some of my businesses, right? My gosh, I need more sales. My bills are high. I got a lot of payments. I got to make more sales. That's the way I'm going to fix this. And so you make more sales, but you don't pay attention to your costs. So those expenses, when you start looking at these documents, you can see your expenses are going up, even though your sales they might be going up as fast or faster. So you want to pay attention to both those. Where's your income and where are your expenses? Are they too high? Are they enough? Okay. And then cost of goods sold. That can be in manufacturing space, really a detriment, is really tracking your cost of goods sold. There's some really good statistics out there that can help you, or not statistics, benchmarks that can help you with industry information. I know, I'm not sure if we have access to it on the SCORE website. or if there's, but I know you can get it from like the SBDCs, which is a small business development center. They can create a report that'll give you benchmarks on your specific industry. And they'll tell you like your cost of goods sold should be like, 32%. And so knowing that is really helpful to you to know if you're keeping up with where, rough idea of where you should be.
I'll just put in a pitch for the Bangor Library. Hannah and her colleagues at the library can help you do a lot of research work on similar businesses to yours and market share and a number of other studies. So if you've got questions or you want some more information about competition, I'd really urge you to call the Bangor Public Library because they've just got an incredible resource there.
One of those resources is their data banks. They have data banks. I forgot about that. Yep. That's great. Thank you. So one of the things, in identifying, there it goes, potential pitfalls, right? It's called financial analysis. And that's what we're talking about. And oh my goodness, doesn't that just sound like a mouthful? Like financial analysis, like somebody needs a degree. They got to have 18 letters after their name if they're doing that, right? Not true. Not true. Financial analysis just means you're looking at your financial reports regularly, that you're making comparisons, that you're taking a look at them and saying, okay, is this the same, better, worse than it was last month, last week, last year, last quarter, whatever that time period is. It's more than just sales and profit. Like it's really all about the ebb and flow of your business. And so what you want to do is you want to make some comparisons. And so this again is where some of that data comes in. Like I mentioned, am I meeting benchmarks for the industry? Are the industries, am I doing what is considered standard for this industry? How am I stacking up to competitors as well? If you see that they're growing and you're not, look at your financials, do financial analysis. What am I doing? Where am I losing money? Where am I spending money? Where am I gaining money? What does that look like? And typically what you want to do is compare within your own stuff. You want to compare 2 or more financial periods. So like sometimes I look at not just this year compared to last year, but I also look back to the prior year, because especially in the last few years where we're coming out of this pandemic created a lot of chaos. What did I look like before the pandemic? What did I look like when we first got out of the pandemic, and where am I now? Okay. So there's like these 3 periods and they're not even close together in some cases. So what we're going to do is I'm going to show you some tools that you can use to help do this financial analysis. So some examples of how this is going to work. You can use one of them, you can use all of them, and it all depends on what you're trying to determine, what you're trying to figure out. So what we want to do is I want to give you some options, and then you can decide what works best for you. And I'm not going to dig in too deep on some of them are just informational, but the ones that I see that are used most commonly. So this is a comparative financial statement. Again, it sounds like this mouthful, right? But really what it means is you're comparing one of your financial documents, one of your financial statements to itself over 2 different periods. So in this case, we're looking at 3 different periods. We're comparing for this particular business, 2017, 2016, and 2015. Now, the way this is presented is backwards to me. Maybe it's okay to you, but I like to put the earliest stuff on the left and the older stuff, the newer stuff on the right. For some reason, that's my preference. Clearly, you can do it either way. And so what we've got here, again, we've got an income statement that we're comparing, but we're also comparing a balance sheet. So just real quick, what do you see? I know it's probably kind of little. Hopefully you can see it, but what do you see that kind of stands out here that you could say, whoa, what's going on here? Good, maybe not good. Go ahead and come off mute and feel free to just gab at me.
The one thing that stood out was the cost of goods sold was jumping pretty significantly year over year.
Mm-hmm. How does that compare to sales though? Is it relative?
I mean,
No
it still
math.
looks like their net income still is increasing. So I think,
Maybe it's okay. Does it make sense, right? Could it make sense for this business? I don't know. We don't know what they do, right? But could it make sense? There you go. Somebody else. What else do you notice?
I think generally it's trending in the right direction. I'd want to see like percentage of cost of goods versus sales, but I mean, it looks like the numbers seem decent to me at a glance. It's, given 1 minute of staring at it.
Yep, for sure. How about with the balance sheet?
Plant assets are kind of dipping a little bit, but not that much. Looks like it's pretty stable. Retained earnings growing, modestly.
Okay, and retained earnings are those earnings from prior years that we're rolling into an account. Like we made this much money over those years. 50,000-foot view, really. Good. So, you mentioned seeing those assets, right? Saw them, the dip a little bit of the dip there. And so, you're in the know. You can be like, oh yeah, hey, listen, yeah, I had to sell or I sold an asset. I had to get rid of that piece of equipment and I got a really good deal on a replacement one, which cost me less. Okay. So you were able to exchange maybe a higher cost item that was originally put in there for something that didn't cost as much and maybe better. So that might explain some of it. And again, it's about awareness and you knowing what exactly you did that affected these statements. Okay.
So Karin, this is a very healthy looking balance sheet. You want to speak to that?
I gotta move my big screen is behind me. So there we go.
So my point was the balance sheet looks very healthy, right? There's there's a lot of equity. There's very little debt.
Yep.
All the while, this business is growing quite dramatically in their sales and profits. Very healthy.
It sure seems to be, huh?
Yeah, I love it.
Go ahead, Steve.
No, I was done.
Okay. We did have a question in the chat about, is retained earnings cash in the bank at the end of the year? Why are the retained earnings not growing as much as the other categories?
So retained earnings is that's your net profit and your net loss being accumulated in an individual account. So at the end of the year, we have to close the books so we can start with a fresh clean set every year. So we got to do something with that net income or that net loss from the profit and loss statement. So what we do is we take that and we move it into balance sheet because again, it's something that you have. It's part of equity. And so that's the accumulation of those net incomes and net losses, the profit and losses over the course of the years to date. So no, it is not cash in the bank at the end of the year. So, most tax preparers, well, most accountants get cringy when I say this, but really, net profit is a made-up number. Long and short of it, it's a number that you use to assess for tax purposes. It includes the true net income, includes depreciation, which is a piece of your assets, not the actual money you paid out. So you don't get to take the whole amount most of the time. And so when you think about, and it's plus or minus taxes depending on which part you're looking at. So if you think about that, if you pay $1,000 for an asset or $10,000 for an asset, we'll make a bigger number. You can only take a piece of that over the course of the life, which could be anywhere from 1 year to 30 years, depending on what the asset is. So if you think about that, you're only taking a little tiny piece of it over the course of a long time. And so your net profit is based on that one little piece, not the whole cost. So there's the cash difference to net profit there, if that makes sense. And so the retained earnings on this particular example might be because they've made decisions to invest in new staffing or invest in other costs and expenses so that their income wasn't as high. And so they're not showing as much profit each year. So it's not growing that fast, if that makes sense. Somehow
And
I
then
can't
David
see.
had asked,
Mhm.
when do you need to bring in a professional? I don't know if you're going to cover that later on or if you want to address that now.
I'm happy. I can talk to that now. So when you choose to bring in a professional it's really dependent on your comfort level. So you're looking at this and you're not seeing the numbers don't look good, right? You don't feel confident in your numbers. It doesn't hurt to get a second set of eyes on it and discuss with either a CPA or a tax professional, what their opinions are, or both. And it's also, again, it's your comfort level. If you see a set of financials that looks like this and you're like, yeah, it feels good, then you may not need a professional until tax time. You may want, if you can afford as well, affordability is a piece of that, but you may want to bring in someone, either, again, CPA or tax professional, or it could be a tax attorney as well, to just affirm what you've said. And it may just be you don't want to deal with it at all and you'd rather have them do an analysis as long as you've got the funding for it. You could do that at any time. When do you need to? Again, comfort level. It's really about comfort level. So the next tool, keep an eye on time, is called common sized. And again, we take the same exact spreadsheet, we take the same exact financials. And what we do is we convert these numbers to percentages. So this involves math. It's also known as a vertical analysis. So basically what you do is you say, okay, what is, when it comes to cost of goods sold, how does it relate to sales? And you create a percentage. And you take those percents and you analyze them across periods again. So, is it 25%? Is it 50%? How much is cost of goods sold compared to gross profit? What's that percentage? So you're going to do some math and come up with these percentages that you can then use to common size. So if gross profit is, 10%, then but it's only 8% the previous year, is it getting better? Okay, so same idea, just involves some math. It does make a little more clear how each line item is affecting the business's profit. So if you find that cost of goods sold is increasing in percent, then you can say, okay, what happens if, and you can create some scenarios to maybe increase your contribution margin, right? Again, more jargon, to your gross profit in order to better shift the numbers a little bit. So again, you're looking at it from what's consistent, and it looks like I put the wrong financial example in there. Yeah, that's what I just realized. So think of it like percent of sales on profit and loss. It looks like I've got the wrong example. I don't have the percent one up. Sorry. But basically what you do is you take it and you take and create percentages of. So do you want to know percentage of how much what's the percent of profit and loss? So example, you might use your labor or your materials as a percent of sales. Okay, so here we've got these selling expenses, right? Are we paying more? What's the percent of sales? How much of my sales is actually selling expenses? How much of my sales is administrative expenses? And so you use that to create the percentages that you can then compare across the periods. The third one, and I'm not going to get into this in depth at all. This is informational if you want to research these on your own, if you want to use them. These are ratio analysis is the most popular. And these are some examples of types of ratios that you can use. They are not an end all be all, but they are part of a bigger picture. They're complex. There are complex interpretations of each one. So the question was, when do you bring in a professional? This might be a great time to sit down with, your banker, with your financial advisor and say, okay, listen, I'd like to know what my return on investment is, a CPA as well. I'd like to know what my return on sales is. So in other words, if I'm making sales, how much of that is actually benefiting me? What's that return to me? What's my profit margin? So again, checking in with the library, getting those reports. You can say, okay, what's that benchmark for profitability? What's that mean? How much, what's my debt to income ratio? That's a big one, right? A debt to income. You hear that on personal stuff too. And so all of these ratios can help you evaluate your financial position and help you understand the risks that you're taking. It also shows, some of these will show you underlying conditions and identify strengths and weaknesses in your building, in your business. For example, an owner may use this ratio to assess inventory activities. Creditors will use it to compare assets to liabilities. What do you have? What do you owe? Everybody's going to use it to assess profitability, okay? In order for these ratios to work, they have to have a relationship. So like debt to income. Do I have enough income to cover my debts? So just a quick piece. The bankruptcy one is not one you hear about. The bankruptcy ratio is important because it can show potential warning signs. So again, getting with a financial professional to say, hey, listen, am I in a good place? Are there any warning signs that I need to be aware of? The fourth one is the cash flow analysis. And I kind of mentioned this before. This is an example of one all filled out. And I put at the bottom this really important ratio. So anytime you're going for funding, you want to create a cash flow projection, and that cash flow projection is going to cover the 12 to 36 months, depending on the funder. It's going to show us where the cash is coming in and where it's going out. And the DSCR, which is in little letters, the debt service contribution coverage ratio, is at the bottom, and it's going to tell a lender if you have enough cash to cover your loan payments. And so ideally what they want to see, if you're going for a loan, you always want to ask your lender, what is their minimum debt service ratio? What's their DSCR? Usually it's up to 20%. I've had them as low as 8. I've seen them around 15 quite often. And sometimes we get 20, which means they want to see 20% of your cash flow available to pay your debts. And so the cash flow projection is broken into sections. The first section being cash on hand. which is, excuse me, cash in, which is your sales and all the money that you have coming in, including your loans and any other equity. This is the investment that we were talking about earlier. Where's that investment coming? Oops, in, my bad. Then you've got your next section, which is your variable expenses, also cost of goods sold. And then you've got your fixed expenses, and then you've got your debt service and other, kind of think of them like the unusual purchases at the bottom, because those are the things that you're going to buy. So again, at the bottom here, we got, equipment purchase. That's that I need to spend $10,000 now. Do I have the cash? Or $1,000 now? Do I have the cash? And then when am I going to be able to recoup that later on down the line as far as cash goes? The fifth tool is valuation. Again, not getting into the details of it, but letting you know there are two types of valuation. One is debt and one is equity. And this is the value that you may want to use to sell, acquire additional financing, entice an investor if you're looking at expansion. And so this particular one is way more complex than we have time for today, but I wanted you again to have it as a go-to, like, oh yeah, there's this other tool that I could learn more about. Okay. Questions? That was a lot of stuff. So I'll give you a minute to sit with it.
All right, I'll throw out another question. So
Sure.
one thing that also has confused me is, with double line of accounting method and all that stuff, like when I want to pay myself from my business, how do I I always get confused with there's got to be an insert point and an exit point, but then you're always kind of showing with the balance sheet that it balances out. And so I always get confused on how I want to pay myself. How does that get annotated when I'm looking at it from an accounting perspective?
Meaning, how are you recording the transaction?
Right, on the balance sheet or the P&L, how does that get recorded?
Okay, so here's a real basic, and I've always loved this. How many of you have heard the song Cotton Eye Joe? He goes, what has this got to do with accounting, right? Where does it come from? Where does it go? So when we're talking about cash, where does it come from? Okay, cash, in your example, it's coming from cash, and cash is something I have, so it'd be on the balance sheet. And then where does it go? So you're either using it to pay for expenses, which affects your profit or loss, right? Or I'm paying myself, and in your situation as a partnership, it's going to be draw. And draw, as we already talked about, is equity. So where does it go? It goes on the balance sheet with equity. Because you're taking cash out and you're converting it to your own dollars. You're converting it to draw. So where does it come from? Cash. Where does it go? It either goes, for you, when it comes to draw, it's going to go on the balance sheet because that's equity, right? You're paying yourself back your investment if you want to think about it that way. Or it's going to be an expense on the profit and loss. So where does it come from? Where does it go? And they're always the same amount, because if I take $100 out of the bank and I put it in my pocket, $100 goes to equity. Well, it'll be draw. If I take $100 out of the bank and I pay the electrician, it's an expense because it goes to the electrician, same amount. Those are the two sides. Where does it come from and where does it go? Does that help? Make more questions. Feel free. Somebody else, anybody else? I don't have any more slides, so feel free to let's
This is your
chat.
time, everybody.
This is your time. Let's chat.
All right, I'll throw out another one. So, you said one of the purposes is for IRS tax purposes, right? So if in the event that I get audited or we get audited, what would the IRS want to see out of all these different charts?
So the IRS is going to want to see your receipts and your bank statements. That's to start. They want to see that you can validate your expenses and that you have reported all of your income. The IRS says all income, regardless of source, is taxable. Who was the gangster? Was it Al Capone that got caught, that they finally caught? And it wasn't because he was a drug kingpin and whatever other, tenacious things he was up to. It was because of tax evasion, because he didn't pay tax. He didn't record his income. He didn't report his income. Like wild stuff to catch, the big bad mafia dude on. But all income, regardless of source, is taxable. So the idea is that you want to have as much as you can possibly account for in reasonable expenditures to offset that income. So what's reasonable? So in real estate management, right? Because I heard you have rental units, right? So I'm not figuring a tennis bracelet would have anything to do. It might be a great gift for your wife, but probably not a business expense, right? But janitorial services would be. And so if you're in an audit, they're looking for the tennis bracelets, right? They want to make sure that you're only accounting for things that are reasonable and associated to the business, not to the whim of the owner, right? Not just spending cash out. So the idea is anything that could be related to the business or is related to the business, you would record. Now, at the end of the year, your tax person may say, hey, listen, you made some good money this year. You need to write some checks. You need to pay some bills. You need to go buy something, right? That's a good tactic that some accountants use to lower your tax burden. And there are rules that allow you to deduct certain amounts. And so in that case, you may not have the cash in the bank, but you have the profit, and they want to lower your profit, right? Because they don't want you paying tax on your profit.
Karin, I really, I think you've broken down a lot of terms that people hear about all the time and made them a lot easier to understand. And I want to pick up on something that you talked about, which was a lot of people feel like the financials are more for the IRS and for paying taxes. And I think one of the messages that SCORE has with our clients is that this is your business. You need to know your financials in order to grow the business, whether to be more profitable or to make it bigger. You spending time on the financials is just really an important part of your business. And if this isn't your thing, you can get a bookkeeper, you can find someone who may be your wife or your daughter or whoever, it is their thing. But I think one of the messages we really want to get across is that the financials knowing them and understanding them can really help you have a much more profitable and successful business. And so this is something that pay attention to yourself. Make sure that you're looking at the numbers on a regular basis, because you can really learn a lot from this.
It's all about, it's about the health of your business. As business owners, we get very much distracted by the things that we do. Okay. So, excuse me, I had a garage door business at one point. Let me tell you, I loved making quotes and doing the calculations and talking to the customers and getting that stuff done, doing the business, not paying attention to the being in business. And that's what these financials help you do. They help you be present in the condition of your business and help you understand the condition of your business and where you're at. Because if you're not doing well, you may miss it. And if you miss it, it could be detrimental. And we don't want that for you. So I'm glad that you came in here. I'm glad that you were here. So I'm just going to click through these last two slides. I believe they're going to get an email survey. And so if you could, I call it my report card. whether that's true or not. But please share your experience. And if you need to connect or want to connect with a mentor at SCORE, there's a link down here that you'll get the PDF and it'll be in there. And anyways, so click through and hook up with someone so that you can get your questions answered. So I'm going to stop share.
Superb job. And we'll do a little pitch, Hannah and I, for next month. I don't think any of you are craftspeople, but our workshop next week is we're going to have a number of people who show at craft fairs, and we'll answer the question, what I wish I knew about going to a craft fair before I started doing it. So if you know of any friends, colleagues, or whatever who go to craft fairs, we've got 3 dynamic panelists who all go to craft fairs and are going to share a lot of advice. And then we just nailed down our December workshop, which is kind of a HR 101. So for those of you who never envisioned hired employees, there'll be some really good discussion around how that goes. Hannah, have you got anything to add? Maybe the dates, if you can remember them.
Yeah, no, I've got it down. So the craft fair panel is going to be on Wednesday, October 25th. And the sort of employees HR workshop is going to be November 15th. And those are both at noon. And you can sign up on the library's calendar or drop us an email and we can get you signed up. We did have one last question pop into the chat from Laura, who asked, do you think it's feasible to track it all without an automated system by using spreadsheets? So I don't know if you want to say one more word on that, Karin, before we head out.
Keep it simple. If it's what you're comfortable with, use it, because it's all about using it. And as long as you're using it and you're comfortable with it and you're staying up with it and you're able to explain it, use it. So whether that's pencil and paper or spreadsheets, the challenge with both of those pieces is converting them into the statements, into the financial statements. So that's the only downside to those, is that then becomes a manual process to create your business financials.
Thank you. And David, did you have one last question or comment to finish us out?
Yes. I've been in business in Maine for 15 years. It's a relatively simple business. And I'm a whiz with Excel. I started out tracking all my financials in Excel, and I would say, don't do it.
Some sage advice.
Fair enough.
Yeah. When I, was introduced to QuickBooks and I got some training from, a friend who's an accountant, that made my life so much simpler.
There you go. Real life stuff.
Right. Well, thanks to everyone. Really appreciate the attendance, great questions, and great information sharing. Thank you.
Thanks for being here,
Thank you all
everybody.
for being here. Thanks again, Karin.
All right. See ya.
Have a good day, everyone.